Welcome to the Fund Your Retirement podcast.
I guess the key message with contributions, if you're putting in the minimum contributions, again, this is not advice, but if you're putting in the minimum contributions to a pension and you've got no other plans for retirement, you haven't got several properties or large assets elsewhere. If that's your plan to put in the minimum, don't expect anything more than a minimum retirement. Which means you're going to be struggling, and that might sound a bit brutal, but that's the honest truth. And
it's an important message.
Yeah, and there are far too many. I do a lot of work with employers and around workplace pension schemes, and the vast majority of people are contributing the minimum. And if you haven't got plans elsewhere, that's all of the financial planning is about, is having a plan. It's better than no plan. Yeah, just you get expect the minimum retirement. You can.
Hello and welcome to the Fund Your Retirement podcast. My name is Lee Cleesby and I'm the co-founder of Fund Your Retirement, welcoming you back to your weekly insights from our expert guests in finance, business and wealth building strategies, helping you fund your retirement. Today I'm delighted to be joined by Oliver McDonald. Oliver is an independent financial advisor and director and owner of Engage Wealth Management. Oliver helps individuals in all aspects of financial planning, including retirement, protection and inheritance tax planning. Oliver also helps many businesses and their employees understand workplace pensions. Many pay into a pension and have no idea where that money goes to or how their future retirement might look. Oliver helps those businesses communicate the importance of a workplace pension and how that contributes to the overall retirement planning and well-being for the employee. Hello, Oliver. Thank you for joining us today.
Hi, Lee. Pleasure to be here, mate. How are you?
I'm absolutely brilliant. Now, I know you've just said there in when we were chatting that this is your first podcast. Thank you very much for giving me the kind honor of your first podcast. Never know, maybe the first of many.
Hopefully, you're welcome, and thanks for the invite. It's to be here, and
don't worry, we'll just relax.
We'll
we'll share your knowledge and insight around pensions and helping people understand more about them and how they can actually be quite. Although perhaps maybe, do you think some people find them a boring subject, the idea of pensions, or something that people don't think about as much as they should, maybe?
Much like a will and much like life insurance, it's one of these things that gets pushed to the back of the mind. But yeah, I do my bit to make them a little bit more interesting for the people I come across.
Brilliant. So before we do get going though, and we'll get into the nuts and bolts of pensions and try and lift a few of the myths around them. I like the guests to share a little bit about their journey, how they got started, how they got to where they are, just so the audience can get to know the guest a little. So Oliver, would you like to take it away? How did you get started in financial planning, and what's been your journey so far?
Absolutely. So I guess I'm one of those rare people that actually wanted to do this as a career.
Wow!
It seems every podcast guest is somebody that's fallen into the industry or parents owned a business and they've naturally sort of gone into that route.
Natural progression that way.
It's the opposite. Parents have nothing to do with finance, neither siblings, and I decided that this was a career I wanted to do. But I after doing school and A-levels, I decided, should I go to university or should I do something much more fun, which was going out and working in ski resorts in the French Alps. So nice. I did that instead, and did that for a winter and really enjoyed it. And so much so that I came back for 6 months and went again.
Right.
Enjoyed it again and then decided to do it again. So 3 years later, I'd spent 3 years in the French Alps.
And then were you thinking, I need to start thinking about my career here?
That's it. Yeah, I thought maybe I should do something with my life now. And it's good fun, but thought, let's do something. So what am I good at? At that time, I thought, I'm very good at numbers. I do like maths, but I wasn't any maths whiz, but I do enjoy it. And I found the whole monetary system, just found it interesting. So I thought, what's numbers related? That's obviously accountancy. So went to the hotel accountant that was working out there, an English guy, and he said, you can do your ACCA exams and everything and become an accountant. And he said, have you thought about financial advice? And I thought, I said, well, what's that? He explained a bit more that it's not so much sitting behind screens. You do a bit more going out and seeing clients, and you're still dealing with numbers, and you're dealing with with the monetary system and everything. And it's but it's a bit more interesting because you're going out and seeing people. So yeah, came back at ripe old age of 20 and thought, let's give that a go. And came home, well, no money, no career, and thought let's buy some exams and put them on the credit card, and then started studying.
Oh, that's how you got started, was it? Wow.
Yeah, no experience, no knowledge of it in the industry. And then did exams, which took 9 months. That's at that time as a certificate, so it's a little bit easier. It's back in sort of 2008. Then managed to get a job at Barclays just as a cashier, and thought, work my way up, become a financial planner.
Get your foot in the door sort of thing.
Had grand plans. I thought, I'd be a financial planner within a year or so. That was right in the middle of the financial crisis, and I was 21, and
it wasn't happening that quick.
No. And the financial crisis, that all the banks got rid of their financial advisors, so that the market was just saturated. So I started worked at Barclays for a while. 2012 hit, which was the RDR, which is more exams and more regulation in the industry, which is great. But I didn't do those exams. I then decided I'd do a bit of traveling. So I went off traveling around South America, came back and did the same thing, and ordered my exams again, and thought, right, this time did my diploma.
Round two.
A little bit older, a little bit mature, got the life experience, and did my diploma, got a job at Lloyds Bank actually, as an insurance specialist. And then, soon after that, managed to get into a financial advice company, an independent firm down in Brighton. And worked there several years, worked up from a pretty much trainee advisor up to director level. And got to a certain point where I could have sat there for another 10 years or do my own thing. So decided to start my own company instead, and did that. Well, started planning in 2020, and then we launched last year in 2021. So
right in the pandemic.
Right in the middle of the pandemic. And we I didn't make it easy. We've gone directly authorized, which is a bit more tricky, independent, and started last year, and it's going well. It's
it's fantastic.
It's busy. So that's my story.
It's a good journey. So
too long.
You say you're independent, so you're fully independent as well, are you?
Yes, it means we have access to the whole of the market. So for insurance, we're not tied to any insurance providers, and same with investments, we're not tied to any investment providers. So it means in my opinion, most independent advisors' opinion, we can give the best advice on the market. Because we're not ever trying to shoehorn a client into a certain product. We are genuinely independent, which is my opinion is the best way to be. My previous firm were always been independent, so I don't see how any other way would be a different way of doing things.
So one of the reasons why I wanted to reach out to you was I wanted to discuss pensions and try and lift the lid a little bit on pensions. Now, I know you also do financial planning, and you do on that side, and perhaps maybe we can do a part 2 on financial planning as well. But could you explain to the audience, in an overview, what is a pension, and why is it beneficial? Or is that too big a question? Should we drill it down a bit, do you think?
It's one of those subjects that you can,
it's a big overview there, isn't it?
But and I'm not, my job as a financial planner, we cover a lot of areas, but I would say 60 to 70% of what we talk about when it comes down to where your money's going or what inquiries we get, 60 to 70% of those are pension related. We do insurance, we do investments, but a lot of it sort of ties around the pensions, because for most people it's going to be their second largest asset in their life, right behind their property. The pension is normally next. So we do a lot with workplace pensions as well, so helping companies provide pensions to their staff. So what is a pension? My opinion, I did do some YouTube videos before on this, which you might have had a look at.
Well, that's where I did come across you. I found you on YouTube. I found it quite interesting. So I wanted to do something around those.
Yeah, so I mean that's something I'll probably go back to, but yeah, one of the questions on that was what is a pension? And I don't know what the right term is, but I don't think pension is the right term because it just brings up connotations of it's just fairly boring, or for a lot of people it's 30, 40 years in the future. But for most people these days that are saving into a conventional pension, which is they're called defined contribution pensions, the way to think about it is it's just a really long-term savings product or investment product, and that's all it is. Lots of people say, I've got a pension, but it's like, well, what's actually in there? Where that pension is just the name of the wrapper that you've got your money in. But in real terms, it's just a very long-term savings product because you can't access it until, at the moment, 55.
Yeah.
So that's probably the best term for it.
It's
I'm sure
quite
that could be explained better.
No, it's quite interesting you say that, because what you've just done there is kind of reframed what it actually is, isn't it? So people kind of may disregard that's just a pension. Well, actually, no, it's your long-term saving plan for your retirement. But that extra few words kind of it brings a little bit more of a sense of how important it is, doesn't it? It's a long-term.
I think that I think that term as well. You talk about what we do a lot of the time. The words pension and retirement both give that those sort of that they give off feelings of something that's going to happen way in the future.
So far off in the future.
And the word retirement is, little Doris going to the
sitting on a rocking chair,
smoking stamps once a day or something. And that's I think that's where a lot of people get put off. So if you think of this as a very long-term savings account or investment account, and it can be exciting in ways, and even reframing the word retirement to a time when you don't fancy working anymore. That's probably a better way to put it, is that
financially independent is
absolutely when do you want financial independence?
So you save it the pension is essentially it's a vehicle that you're saving in to become financially independent, and the more that one could save into that vehicle, the sooner they can become financially independent. That'd be a better conversation, wouldn't it, to describe a pension?
Absolutely, and I think for a lot of people, the sooner you can stop working as well. But for a lot of people, but some people love their work. But it's I think it can be the industry can probably move a little bit forward on that, and I think that there is work being done to bring pensions into the forefront of people's minds, especially in the younger generation. But it is often something that people think is way off in the future and therefore not worth thinking about.
I heard you mentioned something about a defined contribution pension there. Could you share the difference with the audience of what a defined contribution pension is and a defined benefit pension is? Because they are two different vehicles, aren't they, with quite different outcomes as well in terms of how well some have done with the latter. So
absolutely, absolutely. It's, again, more jargon in our industry, but if we just
let's bust the jargon.
We could do another podcast on just jargon, which is extensive in pension as well. But a defined benefit pension. The way to think about that, there's not so many of them around anymore. Especially active schemes. But they are schemes where you wouldn't actually get to have a pot of money. What you've got is a promise of an income in future. So they may say, when you're 65, you're going to get X amount per year, but that's based on how many years service you give to the company.
How many years employment type thing.
How many years of employment. So the longer you work there, the bigger your benefit at the end. And it's defined by the benefit you're given. Those are really valuable pension schemes because when they first came out, a lot of them were non-contributory, which means you didn't even have to put anything in and you still get a nice pension when you retire.
So it's just part of the employment package.
Part of the employment package, The NHS was one of the first to bring them in. As time went on, companies realised that people actually lived longer.
This was going to be an expensive overhead.
Absolutely. When people are living to 65, 70, it's not a problem. But when they start living to 85, 90, it's, hold on, you're going to have to pay quite a bit here. So you'll see a lot of defined benefit schemes have been modified and there's different versions of them now. And it's not necessarily based on what a lot of them were called our final salary pensions. A lot of them are not based on that anymore. And then beyond that, companies then introduce defined contribution pensions, which is they are defined by the contributions that go in, these are the more conventional pensions that everybody has, where you've got money, you put in money, your employer puts in money, you get tax relief, and then you've got a pot of money at retirement to do with what you like with that. And there's various different options with that at retirement. So essentially you're having to fund it yourself.
So it shifted
through
over the years.
It is. Less generous, there's no sort of getting around that, but there's reasons for that, because people are living longer. So it's it's down to individuals to really fund their own retirement now, which is
so how long ago do you think that shift started taking hold? Was it back in the mid-90s or a bit later, or has it been a steady transition from earlier or later?
That's a good question. Don't actually know. I mean, it's ever since since maybe I'm a little bit younger than the average, but since I've been working, it's been defined contribution schemes, especially. Not many people have been able to join defined benefit schemes since kind of the 90s, because a lot of, especially smaller firms, got rid of them. It's only really big firms that are offering maybe a benefits package that's still very generous back then. And there's still, I think there's around 100 schemes still running, defined benefit schemes, that are still actively, you can actually contribute, or you actually build up benefits through them. But there's been this steady shift to defined contribution schemes, which nowadays, or if you've started working in the last 10, 15 years, 9 times out of 10, you're going to have a defined contribution scheme.
Which is where you're putting in, and your employer is putting in a percentage, but nowhere near what it used to be, where the employer would actually take on the role of funding your retirement. So
pretty much,
the onus is on the individual.
It really is. You do, don't get me wrong, employer contributions are valuable, but these days and I think that's where there's a lot of misunderstanding, is that where people think they've got, I'm putting into a pension, so it's fine, I'll see you at retirement. But if you're going with that sort of minimum mentality, you're going to really struggle in retirement. That is just a big misunderstanding there, I think, and of how less generous they are now compared to the way they were, where perhaps people's mums and dads or grandparents retired on nice final salary defined benefit schemes, didn't even have to do anything really. Both of my parents have those schemes where they've dad actually retired in his 50s, 53, I think he retired on a final salary scheme, gets, I don't know, something like 25,000 a year, guaranteed for the rest of his life. Doesn't really understand what a pension is.
He doesn't never have to worry about it.
He doesn't really know what I do, and and I just explained to him, I was like, do you realize how lucky you are with this scheme? But those days are gone really, and people need to take a bit more responsibility for it.
So let's kind of like let's expand on the importance of contributions into the pension then, and without going into too obviously details, or because obviously we've got to think about compliance, and you don't want to be seen to be giving advice on a podcast, obviously. But
of course not.
but still trying to share a positive message that can help people think a little bit about maximizing their contributions. What are some of the important factors that people can realize with thinking a bit harder about the pension and maximizing contributions, or maybe maxing employer contributions, something along those lines?
I think with the with contributions, I think that's I said before, this kind of something that people need to understand is that just because you're part of a pension scheme doesn't mean you're going to be okay. It doesn't mean you're going to have enough in retirement to live the lifestyle that you want.
You would probably still need to work out projections, wouldn't you? If I put this in each month, how much will I have at X age?
And most pension providers do that. They send out a yearly statement. If you work with a financial planner, they should use some sort of cash flow modeling or software to do that for you. But if you're just employed and you start with the basics, your provider will send those projections each year. They're a little bit skewed sometimes, but essentially they do that. But Yeah, if we just break it down as well, I mean, the minimum contributions in the UK are 8%. So if you make 8% of, there's different categories, but most people have that 8% of basic salary.
Yeah.
So on that 8%, your employer has to put in 3% by legislation, and then you've got to make up the other 5%. But you also get tax relief on your pension schemes. And that's where, again, a bit of confusion comes around. But what that essentially means is you're only putting in 4%. You put in 4%, you get tax release, brings it up to 5%, plus your employer puts in 3%. So for a contribution of 4% that you're putting in, you're literally doubling it on day one through your tax relief and your employer's contribution. If you're employed, that is, if you're, lucky enough to have an employer. So, there's not many investments out there where you can put in some money and then day one it's doubled.
Yeah. Every month you're doubling out. Every month you put in, it doubles.
Every single month. If your contribution that are based on that level. Some employers will offer, they might say, okay, if you put in 6%, we'll put in 6%. So again, it's doing that different
matching. Employment benefits, isn't it?
Yeah, absolutely. And that's why employers can look at that as a benefit as well. But I guess the key message with contributions, if you're putting in the minimum contributions, again, it's not advice, but if you're putting in the minimum contributions to a pension and you've got no other plans for retirement, you haven't got several properties or large assets elsewhere. If that's your plan to put in the minimum, don't expect anything more than a minimum retirement, which means you're going to be struggling. And that might sound a bit brutal, but that's the honest truth. And
it's an important message.
Yeah, and there are far too many. I do a lot of work with employers and around workplace pension schemes, and the vast majority of people are contributing the minimum. And if you haven't got plans elsewhere, that's all of the financial planning is about, is having a plan better than no plan. Yeah, just you get expect the minimum retirement. You can put it up to depends on your earnings, but if you're earning more than 40,000 a year, you can put up to 40,000 a year into your pension scheme. Right. So I think that's where a lot of people don't realise that as well, that you can increase your contributions, and you can. Your employer might increase them as well. I don't know, it depends on your employer. But you can increase your contributions, and it should hurt a little bit, in my opinion, the monthly contributions. If you don't notice it each month and it's just something that's behind the scenes and you never really see that really sort of feel that money going out, then it's probably not enough.
Right.
But of course. Yeah. Not advice, but that's
no. And before you make any decisions, go and see a regulated advisor, book an appointment with Oliver.
You can put that at the beginning on the end of this. But I think that's what there's a lot of misunderstanding around contributions with these schemes, because I mean it was only in 2012 onwards where this was legislation. In the UK, this was brought in by law that employers have to offer or have to automatically enroll employees into pension schemes. So up until that point, it was even worse. So it's getting better, which is great. But 8% of your 8% contributions isn't going to produce a comfortable retirement for most people.
So what you said there is pretty important, I think, because you've just kind of said, really, it should hurt. You should notice it, and if you're not noticing it, then you're probably not contributing enough. But again, not advice. Please book an appointment with a regulated advisor. Give Oliver book an appointment with Oliver. Have a chat, and he can go through the details with you. But it's a really important message, and something that I think people perhaps probably don't think about too much, as we've said at the beginning, because it's so far off into the future. And the word pension, the word retirement, hardly invokes feelings of kind of excitement and inspiration, does it? But
no, it shouldn't either. It should be boring. That's the thing. You want your life savings to be boring. But you also need to take notice of them. And it's often something that's misunderstood a bit.
So you mentioned there that you engage with employers as well. So you actually, because I think perhaps maybe most people think of financial planners working with individuals, but you mentioned there that you actually work with employers. And is that going into the company and working on their pension scheme, working with the employees as well on their contributions?
Yeah.
Okay.
Yeah. It's we offer a couple of levels of service with our my background is a lot when auto enrollment came out, which was where every employer had to put in a pension scheme. My previous firm, we helped a lot of employers do that. We're now on the sort of the second phase of that, where I come across employers that have grown rapidly, but they've still got fairly basic pension schemes, either in the minimums, or they've got one of the default investment options, the default pension options. So our service is twofold really. We work with employers to review their current pension scheme.
Right.
So that, this is what you've got currently. Is there something better we can do elsewhere? Do we look at changing the contributions? And we have a sort of big discussion. And if that's the case, we can get a better deal elsewhere for the employees where it's lower cost. Then potentially we'll look at changing the pension scheme, which is quite a big job in itself, but it's something we do, and that could be for employers that have got 20 staff or employers that got 2,000. So we work with quite a range of employers on that level. But then we also, the bigger part of what we do is really engaging with staff. So working with employers on an ongoing basis to go in and we do pension surgeries where we'll go in once a year and sit down with anybody that wants to book a meeting with us, really. I'll say we go in, we don't go in many places anymore.
Probably book a Zoom call, is it now?
Book a Zoom call, that's the way it's done now. So one-to-one meetings. Really the idea behind that is really to drive staff engagement, and from an employer's point of view, you've got two levels there. If you're offering, a fairly basic pension scheme with the minimum contributions, you're not going to attract and you're not going to retain quality staff. If you want to attract and retain quality staff, you need to look at your whole sort of employee benefits package, which my partner business do a lot on private medical insurance and the employee benefits side, and then pensions ties in quite nicely with that. And if you're offering, rather than putting in the minimum 3% as an employer, if you're putting in 10% as an employer,
more attractive.
That's a lot more attractive to existing staff and new staff, and that's the feedback we've been getting. Is a lot of, especially tech firms that have grown fairly rapidly, coming to us and saying, look, we're going through interview process, and this one thing keeps coming up is, what pension have you got? That doesn't seem very generous. Can we do something else? So we'll review the schemes and potentially look at changing it, which helps to attract and retain staff, and then but also the actual engagement of the staff as well. We talk to them about where their money's going each month, where it's actually invested, what the contributions do, what tax relief is, and just try to get people interested a little bit more.
Just educate them on
workplace pension schemes. A bit of education. Yeah, absolutely.
Where does the money go? Because it's not something that too many think about, is it? It just, you see it on the pay slip.
Absolutely, into the ether, and where it goes.
Where does it go?
65. It's that's another thing. Is I didn't really appreciate this until I started talking to staff about it, and people just had no idea really.
Can you imagine?
To give you an idea, I mean, for most, almost every pension scheme, workplace pension scheme, will have a default option. So staff don't have to choose where their money is invested, but they have a default fund, and that's where most people's money goes. So your contribution, your tax relief, and then your employer's contribution all goes in, and it goes into the default fund. Now that fund is made up of different investments. And again, fund is or pension is just the wrapper name. Let's lift up the bonnet on that. And what you've got underneath is, most people, depending on your age, but generally if you're under the age of 50, you'll be invested mostly in shares. And that's not just some guy behind the scenes picking Apple and then deciding to move that to Apple to Google or Microsoft shares. There are normally hundreds or thousands of shares within that fund.
Diversification, well diversified.
Absolutely, invested all over the world, all different industries, and the idea behind that is that stock markets, and that's essentially what you're investing in, stock markets go up over time. that's a fact. They have historically done all that in the past. We can only assume that happens in future, but of course we don't know. But generally they go up over time, and that's why investments are more popular for long-term investing. So most people's funds are in stock markets. There'll also be other what are called asset, don't want to throw more jargon at everybody, but more asset classes in there. So you're going to have bonds, you might have even property in there, might even be some cash, and that is where it's essentially invested for you. Most pensions, and again, some of the people don't understand is that, well, not most, all pension schemes have other fund options. And you can invest, you don't have to stay in the default funds. You can go into lower risk funds. You can go to higher risk funds.
Oh, interesting.
You can go, there's normally a lot of pension schemes now have funds that offer ethical funds or sustainable funds. And I think that's a massive, sorry to jabber on, but that's a...
It's really interesting. Hopefully people who are listening taking this in, because it's a really interesting conversation and helping people understand their saving vehicle to fund their retirement so they can become financially independent instead of...
Let's hope so. But yeah, I mean, that's... that thing on the sort of the risk subject, that is huge, because if you go into a default fund, you might be mixed in, you might have some shares in there and some bonds and cash. Somebody in their 20s or 30s, to be honest, even in their 40s.
That's just what I was thinking when you were saying
don't need to be in bonds and cash, but that's my opinion. It's not. Again, that's for people
just
to make their own decisions.
Just a chit chat with
but if you can, there are options, and that's the problem with it when it comes to the word risk. People think, I could lose some of my money here, but risk is good for especially if you're young. If you can invest in something it depends on what you're investing in, but generally with pension funds, a higher risk fund will simply be 100% in shares rather than 60 or 80%. It's going to be 100% in shares normally. Still diversified, still globally diversified. Hundreds or thousands of shares in there, but people in their 20s, 30s, and 40s, that's where they should be. The default option with some pension schemes, I think, is I don't think it's right, but I kind of see why they do it as well, because for a lot of people,
it's safety, isn't it?
It's going to be their only investment or their first experience of investments. So if they see, it's gone down for the first year I've put money in, it's not worth it, and that's the last thing you want. So I see why they do it, but I think it's almost criminal. That's my opinion.
So what type of questions can the individual ask the employer to find this information out then around, someone who's 25, 30, 35, what type of risk am I in, and are there other available options? What pretty much that's it, I guess, isn't it, really?
I mean, you can do things yourself, and especially if your employer doesn't have a financial planner attached to the scheme. So someone like ourselves, if they don't have us, then you'll need to ask your employer or the actual pension provider directly. So let's say it's with Aviva, you can call Aviva and you can find out, or you can go online and you'll find out what other options are available. Some companies are better at this in sort of showing you than others. Some of them are a bit more tech advanced. So they'll literally go on there and you'll have different portfolios that you can invest into. In terms of finding out, am I risk? Most people will know if they're risk averse or happy to take a bit of risk naturally, but they can, there are risk questionnaires that you could do online, and that's what a financial planner would do with you if you worked with somebody individually. But your employer or the provider will be able to provide a bit more information on the other funds that are available, and especially with some of the bigger companies. So I don't mind name dropping a few here. That's okay, isn't it? I guess.
Oh yeah, absolutely.
The likes of Aviva, Royal London, Aegon. There's hundreds of funds available in there, or they've even got pre-constructed portfolios for you on different risk levels. So you can't go too far wrong, but it does require somebody to be a bit proactive and take a bit of an engagement in their pension scheme, which most people don't end up doing, or they'll talk about it once and then never go back to it. So taking a bit of interest, and that's a lot of what we do when we go into workplaces, is get people to take a bit of interest in their scheme.
Yeah, well, I suppose I'm presuming most individuals probably pay the minimum. They've no idea where it's going. And a few simple questions of, hey, where's that money going? What type of risk fund is it going into? And can I actually pay more? Can I actually contribute more to this pension? Because, well, that could make a huge difference to one's nest egg at the end of at the end of the journey, couldn't it?
Thousands or tens of thousands in cases where if you get it into into the right fund and you're contributing even just a few percent more,
just a few percent
what you're doing now, where it doesn't. We kind of, like we said, you notice it going out rather than it just going out each month, and that can make an absolutely massive difference to your future. But it does require a bit of interest in pensions. So hopefully this podcast will get a few people logging on and having a look at their schemes.
We've probably just got a load of employees marching into their employer's office.
Yeah, sorry about that.
Next week now, demanding.
There you go.
So some
tell
people will be happy.
Find me.
Well, exactly.
Tell them to call Engage Wealth Management, and I'll take care of it all. But that's a good thing in a way. If people are taking a bit more interest.
Yeah. Well, from an employer's perspective as well, just listening to you, there's actually engaging with somebody like yourself could actually really benefit the employees as well in getting involved in better funds and better, and just educating their workforce around the benefits of a pension, as you elaborated earlier on in the conversation. So, even that, engaging with people like yourself, bring them into the office environment or booking Zoom calls under the workplace sort of environment can be really beneficial to helping people fund their retirement and get to, achieve the goal. So, I mean, absolutely brilliant. I mean, the amount of insights there, I think, has been fantastic. So, as we come to the end of the conversation, what type of myths would you like to bust around the pension sort of industry? Some of the myths that you've come across over the years, common sort of questions that you just like to let people know are, done.
I guess it's a few. Go on with it here, but I think if one of them is, especially nowadays, and the reason I say that is, I'll come back to that, but or there's a myth out there that it's not worth putting money into a pension, or it's they know somebody that lost all theirs in the 90s. That simply can't happen these days, and we'll kind of guess if there's a fraud, but you're very well protected as retail investors these days. So not worth it. Well, these days, and that's I think where there's a lot of confusion around when you access your money, how you access it. In 2015, there were new rules brought in with pension schemes, which increased the flexibility when it came to actually accessing your money. Okay. So you're not tied into taking a monthly income, which that's what a lot of people say, it's not worth it. I'm just going to get a few £100 a month. It's not worth it. Well, no, you actually get a pot of money. And then if you decide what you want to do with that money at retirement, if you want to buy a monthly income, it's called an annuity, you can do that. But nowadays there are much more flexible options on the market where you can draw what you want when you want. So, I get a lot of people, especially when they're maybe slightly older, when they're maybe in their 50s, and they're joining a workforce for the first time, not for the first time. So when I'm speaking to them, when they've just joined joined a company, and they're deciding whether, should I stay in the pension scheme? But, well, you're getting free money from your employer. You're getting free money from your tax relief from the government. If you're a higher rate taxpayer, you get even more free money from the government. And your money is going in there, and it's probably going to be worth more in future. Hopefully, if it's invested correctly, based on historical past performance, based on past performance, but that's not a guide to future. Absolutely. But if even if you join that pension scheme, you're going to still have a pot of money that's invested tax efficiently. You can take out 25% tax free when you're older. You can take the rest of it flexibly, however you want to. So I think that's one of the massive things that people still confuse with that kind of. They've got their mentality from sort of pre-2015, where if you put in money into a pension, it's tied up to 65, and then you just get a monthly income. Not the case anymore. You can access funds earlier than that. You can access them flexibly. So yeah, it's very difficult to find somebody where it's not worth them putting money into a pension scheme.
Okay.
And then on that subject, I think one of the other big things is, what if I die? It's gone.
Yeah, that's something that you do hear quite a bit, isn't it?
Yeah, and it's again, that sort of stems from the days pre-2015 when people used to buy annuities. People still do buy annuities, but they're not as popular.
Right.
You bought a single annuity, essentially if you died, it was gone. Or if you've got a defined benefit scheme. So my dad, for example, he's single now, so if he passed away, his pension doesn't get paid to anybody.
Right. Yeah.
These days where everybody's got defined contribution pension schemes, and where most people are choosing the sort of flexible route at retirement, that money is not lost if you pass away. So if you retire and you go down, as long as you go down that sort of flexible route, and again, that's not advice. And if you go down that flexible route, that money is not lost if you pass away. And even if you die whilst you're working still, if you died at 50, that money's not lost. It goes to your family. It goes to whoever you've written on your nomination form. And I hope everybody listening has filled out one of those nomination forms. If you haven't,
another great insight.
Go and get in touch and with your provider and fill one out. That's So one of the other myths that is really that people think it's lost on death, or it's not worth it. But it's very difficult to find somebody where contribution to a pension is not worth it.
Brilliant.
But, that's all from all the myths.
Two massive ones there, because I suppose that the money disappearing on when you pass away, it's probably left over from the defined contribution kind of era, isn't it? When the employer was paying for the person in retirement, whereas when it's
defined benefit era, absolutely,
defined benefit era, sorry. But when it's defined contribution, that's your money, that's your pension. So you do have the ability to pass it on to whoever.
Yeah, because and that back, it wasn't so long ago where you either had a defined benefit scheme, but sometimes it would pay out to a spouse, which if you're married, then it would pay out to them as well. But after that, it's gone. And then the same with annuities. If you had a defined contribution pension, you would buy an annuity at retirement. And that would pay out to us. Again, you could buy a joint annuity and you pay out to a spouse if you passed away. But those days they're not gone, but they're still
diminishing.
All my individual clients now that are retiring, I still often come across people with defined benefit schemes, and there's a big conversation around those. But if you're saving into a defined contribution pension now, it's number one, if you're up until you retire, that money, if you pass away, it goes to whoever you've nominated. And then even after that, where most people are choosing the flexible route, it still goes to whoever you've nominated on there. Go to a spouse, can go to children, it can be passed down generations. So it's all very flexible these days.
Oh, brilliant. Absolutely fantastic. So Oliver, where can people connect with you? Where can they follow you? Where can they, more importantly, book a call with you? Because, anyone who's listening to this, an employer or an employee would, I think, benefit from having a chat.
Yeah, absolutely. So we've got, on all the social channels. So it's LinkedIn. You've got myself, which is Oliver McDonald. And we're also on there as Engaged Wealth Management, on Instagram and on Facebook. We're not on Twitter as Engaged Wealth Management. It's not an area where we've gone yet. But or obviously pops our website, which is engagedwm.co.uk, and you can book in with me there.
And I will make sure all the links are in the show notes just below. So if you're listening or watching, please go to below. There's a show notes, and you'll be able to follow or connect with Oliver. So thank you, Oliver. That was a really good conversation. Thanks for sharing your insights, your knowledge, and hopefully we've inspired people to get engaged with the pension.
Get engaged. There you go. So as long if we've inspired one person, then we've done our job. So pleasure to be here, mate.
Cheers. Thanks, Oliver. Have a great day.
Nice one, Nick. Cheers.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and our website, fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.